When the word recession makes headlines, most people feel nothing but fear. They picture crashing markets, companies shutting down, and job security slipping away. It feels like a storm that can wipe away years of hard work. But what if I told you that inside this storm lies a hidden door that could lead you to life-changing wealth? History has proven time and time again that the wealthiest investors did not rise to the top during the good times. They made their boldest moves when the economy looked its worst. Welcome to FinTech. Innovate AI, the place where complex personal finance topics turn into clear, practical strategies you can use right away. In today's video, we are diving deep into why recessions, which most people run from, could be the very reason you get ahead financially. We will explore how to spot golden opportunities when the economy slows down, how smart investors think differently from the crowd, what steps you can take now to prepare for the next market rebound, and there will be a bonus tip for my audience. So without wasting time, let's start. 1. Understanding a recession. The foundation, understanding a recession, starts with seeing it for what it truly is. It is a time when the economy slows down, companies earn less, and people begin spending cautiously, stock prices fall, businesses close their doors, and the news makes it sound like growth has stopped completely. But here's what most people miss. A recession is not just a season of decline. It works like a reset button for the market, clearing away the excess and inflated prices of the past. Assets that once felt out of reach suddenly become affordable again. For investors who are prepared and patient, this reset creates rare opportunities that might not return for many years. 2. Why prices drop. The investor's window. Imagine walking into your favorite store and finding that everything you ever wanted is marked down to a fraction of its original price. That is exactly what happens in the investment world during a recession. Fear spreads quickly, and many people rush to sell their stocks, real estate, or mutual funds just to feel safe. This sudden flood of selling drives prices far below their true value. It is not because the companies or assets are worthless, but because emotions overpower logic. For a smart and patient investor, this becomes the perfect window to buy quality assets at deep discounts, knowing that once the economy recovers, these same investments could rise far beyond the price paid. 3. Historical proof. Lessons from the past. To understand why recessions can be golden opportunities, let's go back to the Great Recession of 2008. Markets were collapsing, banks were failing, and fear was at an all-time high. Many people pulled their money out of investments and swore never to return. But a smaller group saw something different. They looked at strong companies with solid foundations and realized their prices were temporarily crushed by panic, not by poor business fundamentals. Those who invested in the S&P 500 in early 2009, when the market was still trembling, saw their money more than triple in the next decade. And this was not a one-time event. From the crash of 1929 to the dot-com bust of the early 2000s, history shows the same pattern over and over. The toughest times often set the stage for the biggest recoveries. 4. The psychology. Advantage. Thinking differently. Picture two investors watching the same news report. The markets are deep in the red, prices are falling, and the headlines are screaming about an economic collapse. One investor feels a knot in their stomach and sells everything in fear of losing more. The other leans in with curiosity, seeing the falling prices as a rare discount season. This second mindset is what sets wealthy investors apart. They have trained themselves to stay calm, think long-term, and act when others are frozen by fear. Instead of reacting to emotions, they focus on the bigger picture, that the market has always recovered and rewarded those who stayed invested when times looked darkest. If you can think like this, you position yourself to make the bold moves. others are too scared to take. 5. How to identify the right investments in a recession. When the economy slows down, not every investment will recover at the same pace. Some businesses may never return to their former strength, while others emerge stronger than before. The key is knowing how to separate the two. Start by looking for companies with strong balance sheets, meaning they have low debt and plenty of cash on hand. These businesses can weather the storm without collapsing. Next, focus on steady cash flow. Companies that continue earning because they sell products or services people cannot live without, even in tough times. And for those who want a safer approach, index funds and blue-chip stocks are proven choices. They represent large, well-established businesses with a long history of surviving downturns and rewarding patient investors when the economy recovers. 6. Timing versus consistency. What works better? Many new investors believe that the secret to success is buying at the exact bottom of the market. It sounds exciting, but in reality, even the most experienced professionals rarely get the timing perfect. Instead of trying to predict the lowest point, a far more reliable approach is consistent investing. By putting money into the market regularly, even during downturns, you naturally average out the price you pay for each investment. This strategy, known as dollar cost averaging, removes the pressure of perfect timing and keeps you focused on the long-term goal. Over time, as the market recovers, your earlier investments, bought at lower prices, can deliver substantial gains, and all without taking extreme risks or chasing the impossible. 7. The compounding effect. Why starting in a recession matters. Imagine planting a tree when the ground looks dry and lifeless. It may not seem like the perfect time, but as the seasons change, that small seed grows into something much bigger than you ever expected. Investing during a recession works the same way. When you buy at low prices and hold for years, your returns start to compound, meaning your gains begin earning gains of their own. A modest investment made when the market is down can grow into a surprisingly large sum over time, simply because you gave it the time to multiply. This is why experienced investors often say, fortunes are made in bear markets, not in bull markets. The quiet moves you make during the hardest times can create wealth that feels effortless years later. 8. Avoiding common mistakes. Investing during a recession can set you up for incredible growth, but it can also backfire if you make the wrong moves. One of the biggest mistakes is putting money into companies buried in debt. In tough times, these businesses often collapse before they get a chance to recover. Another trap is chasing risky, get-rich-quick opportunities that promise huge returns but rarely deliver, and perhaps the most overlooked mistake is ignoring diversification. Spreading your investments across different sectors and asset types helps protect you. If one area struggles, remember, protecting your capital is just as important as growing it, because the more you keep safe, the more you can invest when the right opportunities appear. 9. Bonus strategy. Strengthen your financial position. This is the bonus strategy I promised at the very start, and it might be the most important step of all. Before you put a single dollar into the market, you need to make sure your financial foundation is rock solid. That means having an emergency fund that can cover several months of living expenses and tackling any high-interest debt that drains your cash flow. Why is this so critical? Because if you invest during a recession without this safety net, you might be forced to pull your money out at the worst possible time, when prices are still low. By securing your finances first, you give yourself the freedom to leave your investments untouched, letting them grow through the recovery and beyond. This is how you stay in the game long enough to see the real rewards. Recessions may look like the scariest time to invest, but history tells a very different story. They are often the moments when the biggest fortunes quietly begin. The real winners are not the ones who fear the storm, but the ones who prepare, take action, and let time do the rest. If this opened your eyes to how a recession can actually be the perfect time to build wealth, make sure you hit like, subscribe, and share this with someone who's ready to turn tough times into opportunity. Thanks for watching.